When we hear about the American dream, we usually think of a house, a car. But what if it also meant owning a piece of the action, a slice of the very companies that shape our everyday lives? Well, that's exactly what the US stock market is all about. It can seem like this incredibly complex, even intimidating world, but today we're going to pull back the curtain. We're going to show you that it's really an engine that gives everyone a shot at owning a piece of that dream. So, here's how we're going to break it all down. First, we'll decode what a stock actually is. Then, we'll get into the two big reasons the market even exists. After that, we'll check out where all this trading goes down, cover the rules of the game that decide prices, and finally, we'll talk about how you can find your own seat at the table. Let's dive in. All right, first up, let's decode this thing. Before we can get into any of the exciting stuff like market trends or big gains, we have to lock down the single most important building block of this entire system. I mean, really, what is it? Beyond all those flashing numbers and complicated charts you see on TV, at its very heart, the stock market is just a huge worldwide network that connects buyers and sellers. But what on earth are they actually trading? This right here is the whole secret. A stock isn't just some number on a screen. It's a real, actual piece of a company. Think about the phone in your hand or the coffee you're drinking. If you buy a share of Apple or Starbucks stock, you literally become a part owner of that business. A shareholder. Once you get that, everything else starts to click into place. Okay, so now we know what is being traded. The next big question is, why? Why does this giant, complicated system even need to exist? Well, it turns out it actually serves two totally separate and really critical purposes. And this is a difference a lot of people miss. First, you've got the primary market. You can think of this as the birthplace of a stock. It's where a company first goes public with an IPO, selling brand new shares to raise cash to grow and expand. But then you have the secondary market, and this is what most of us think of as the stock market. It's where you and I and everyone else trade those shares that already exist among ourselves. The company isn't really involved in these day-to-day trades, it's a marketplace just for investors. So, companies issue shares and investors trade them. But where does all of this actually go down? It isn't just floating around in space cyber. Let's take a look at the two main arenas right here in the US where the action happens. You've got two major players. On one side, you have the icon, the New York Stock Exchange, the NYSE, also known as the Big Board. It's that famous building on Wall Street. It's the traditional home for many of the biggest, oldest, most established companies, what folks call blue chips. And on the other side, you have the tech-heavy disruptor, the Nasdaq. It's an all-electronic market, and it's famous for being the home of the world's biggest tech and innovation giants. Two different feels, but both are at the center of the financial world. And that brings us to the really fun part, the action itself. We know what stocks are, we know where they're traded, but what actually decides their price? What makes them shoot up one minute and dive the next? From the outside looking in, it can seem like total chaos, maybe even random, just a storm of news headlines, company reports, and expert opinions flying everywhere. But underneath all that noise, there's actually a single, simple principle driving everything. That's it, plain and simple, supply and demand. It's the exact same force that decides the price of gas at the pump or tickets to a concert. At the end of the day, a stock's price is just what the market is willing to pay for it based on how many people want to buy it versus how many people are trying to sell it. Just think about it for a second. Let's say a company announces some incredible new product. Suddenly, everyone wants to buy their stock. That's high demand. But not many of the current owners want to sell. That's low supply. So what has to happen? The price has to go up to convince some of those owners to part with their shares. And of course, the exact opposite is true too. If some bad news comes out and all the owners rush to sell their shares at the same time, that's high supply, but not many people are looking to buy, well, those sellers are going to have to lower their asking price to find a buyer. The price drops. It's a constant tug of war. Now, of course, that tug of war doesn't happen in a bubble. A whole bunch of things are constantly influencing that balance of supply and demand. Things like, how is the company actually doing? Is it making money? That's probably the biggest one. What about the economy as a whole? Are interest rates going up? That changes things. What about trends in the industry? Is some new technology about to make this company's main product obsolete? And finally, you have pure human emotion, what we call investor sentiment. Sometimes just plain old fear or greed can move the market more than any financial report. With literally thousands of different stocks out there, it's impossible to keep track of every single one. So to get a quick pulse check on the market's overall health, we use something called an index. Just think of it like a scoreboard for a big chunk of the market. And these are the big three scoreboards you'll hear about constantly. The S&P 500 tracks 500 of the biggest US companies from all different industries, so it gives you a really broad view of the economy. Then there's the Dow Jones, which is much more exclusive. It only follows 30 huge, well-established companies. And finally, the Nasdaq Composite tracks every stock on the Nasdaq exchange, which makes it our best snapshot of how the tech sector is doing. Each one tells you a slightly different part of the story. All right, we're at our final section, and this is where we bring it all home to you. Because this is all interesting, but what does it actually mean for you personally? Let's talk about how today's market is built to be safe and surprisingly easy to get into. First things first, safety. It's not the Wild West out there. The entire system is watched over by a powerful referee called the SEC, the Securities and Exchange Commission. Their main job is to make sure the game is played fairly and to protect everyday investors, like you and me, from things like fraud or manipulation. That trust is the bedrock of the whole system. And maybe just as important is how accessible it's all become. You know, it wasn't that long ago that you needed to know a guy, a special broker, and have a ton of cash just to get your foot in the door. Today, thanks to online platforms, anyone with a smartphone can open an account in minutes and become an investor. Those old walls have pretty much been torn down completely. And that really gets to the very heart of it. The stock market isn't just some casino for the rich and powerful. It's a critical engine for our economy. It helps great companies fund their big ideas, and just as importantly, it offers millions of regular people the chance to participate in and benefit from all that growth. So, there you have it. We've decoded the language, we've understood its purpose, we've seen the arenas, and we've learned the basic rules of the game. The stock market isn't some secret club anymore. It's a system that's more open and accessible than at any other time in history. So now that you know the rules of the game, what's your next move?